Welcome to another great White Coat Investor Real Estate webinar. I'm here today with Michael Episcope, Principal of Origin Investments. Welcome back, Michael.
Thanks, Jim, for having me. Appreciate being here.
Today, we're going to be talking about one of my favorite Origin funds, the one I've been invested in, I think, well, maybe not the longest, but that I've been invested in now for years, the Income Plus Fund, which is, one of your evergreen funds, an equity and preferred equity fund that has had a great 2022 and really a fantastic long-term return. But I don't know how many white coat investors are super familiar with the fund. So today we're going to get into lots of detail on it and really help people get to know that fund a little bit better.
Well, great. I'm excited to talk about it. And we do call it our all-weather fund, and it's certainly where I have the most exposure personally at Origin. So that kind of is a testament to my conviction of the fund as well.
Yeah, why don't we let you first present some slides, and then we'll go to the Q&A portion of the presentation.
All right, I will jump in here. Thank you, everybody. My name is Michael Episcope. I'm co-CEO of Origin Investments, and it's a true pleasure today to be able to introduce you to our Income Plus Fund. And this is our all-weather fund, and you're going to learn why over the next kind of 45 minutes that's the case. And certainly we're in unique times here. The macro environment is a little shaky. We have an inverted yield curve. We have a bank most of us never heard about 2 months ago, SVB, Silicon Valley Bank, in the news. And we have negative carry as well, meaning borrowing costs are actually above cap rates, and public REITs are actually down 35%. So why is this a good time to invest in real estate? And I'm going to hedge that question a little bit and say there are certain areas of real estate you probably don't want to invest in, and certain areas you do. And I don't think it's a matter of if you invest. We all know what happens to money when you let inflation eat it away. You keep it in the bank. But it's really about how you choose to invest and how you position your money. And I think it's a great time to invest in this fund because of its multi-strategy and dynamic, the way it's designed and the way we manage it as well. So my goal today is really to give you enough information for you to decide if you want to take next steps in partnering with us, investing in this fund. And for those of you who may not have ever invested in private real estate, we make it super easy. Every one of our investors is paired with a specialist on our investor relations team, and they walk you through the entire process. And I would say that there's 2 things that we obsess over here at Origin, returns and client service. And those are the things that we think about every day when we wake up. The outline today, I'm going to maybe spend about 3 or 4 minutes giving you a little bit of background about Origin. I'll give you a high-level fund overview, talk about why we like multifamily, and then go into some of the details of the fund. This shouldn't be more than kind of 35 minutes, 30 minutes or something like that, and then we'll open it up for Q&A after that. So let me go into the first slide here, which is really about Origin. We have been around since 2007. My partner and I, we started the company back then, and it was really, in the beginning, it was about investing our own wealth and addressing what we saw as a void in the market. And we were both high net worth individuals, ultra high net worth. I came from a trading background. That's where I made my wealth initially. And what I found investing as an LP back then was that it was always 2 steps forward and 1 step back, or sometimes 2 steps back. And yet real estate is the great builder of wealth. But really that's only true if you are with the right manager and pay reasonable fees, because one without the other is not a good starting point. And if we kind of go back to 2007s, individuals had the best of bad choices, I will say. They had the choice between high fee REITs and then inexperienced sponsors or experienced sponsors that charged too high of fees. And so the smart money, the institutional managers with a lot of capital to invest, they could command the terms, but individuals could not. So we really set out to build what I'll call as an institutional platform for individuals like me, like my partner, like others who invest with us. And that resonated with a lot of people. And if you fast forward to today, we now have 54 team members. We have 5 offices around the country. We manage more than $1.8 $8 billion in assets for a little more than 3,200 investment partners and many registered investment advisors as well. Wealth managers also use our platform as real estate solutions for their clients. We are ranked as a top decile manager by Preqin. And this ranking, it's because of our consistency across all of our funds. We have our funds have wound up in top decile, top quartile, but the ranking is really because of that consistency over 8 funds that we've launched over the last 12, 13 years. And it's something that we're very proud of. Right? We're not trying to hit it out of the park with one fund, but just be consistent, hit singles and doubles along the way. We strongly believe in alignment, and I don't think there's a better metric to measure that than skin in the game. David and I are the largest investors at Origin. We've contributed more than $75 million in personal capital. We're contributing more to a new fund that we're coming out. That metric will increase to $85 million in 2 months. And so we're still using Origin to manage our own wealth, grow and protect our own wealth as well. And it's a unique position to sit in when you're both the investor and the investment manager on both sides of that table. You look at things very differently. And as I said earlier, I've allocated more to this fund than any other fund because I just like the unique nature of the multi-strat. You get many different strategies within one fund. And the last thing I'll say about us, we only invest in multifamily. We're kind of an inch wide, a mile deep. We do invest up and down the capital structure and then across different strategies. So we will invest in debt. We will invest in common equity. We have the ability to do core plus, value add, ground up development. So a lot of tools that we have at our disposal to really be successful in any market out there. The next slide is sort of a teaser, an overview of the fund itself. And the overarching goal of this fund is to generate a 9 to 11% annualized net return in a tax efficient manner with low volatility. And this is an open-ended fund. And I think that has a lot of advantages over closed-ended funds. We historically have done a lot of closed-ended funds. We've migrated to the open-ended fund. But the advantage, number one, is you get to invest 100% of your investment on day one. It's not called capital over long periods of time. We focus on a metric of annualized return and not IRR in this fund. An annualized return is very simple, that if you make 10% per year over 5 years, you can actually quantify what that means, that your money is growing and compounding at 10%. If I tell you you've gotten 15% IRR, you actually can't quantify how much money that means to you in terms of multiple. And so you have to really look at both. But the big reason why we have shifted to this model is because I believe that real estate, it's just broken in the traditional private equity model where it's buy, fix, and sell. This is more of a buy, fix, and hold. Real estate has amazing tax advantages, but to get those tax advantages, you have to hold real estate. And what we do is we buy an asset, great locations, create value, and then in this fund, we hold it. Typically, it can be forever. Investors have the ability to get out at the fund level, but as a manager, this is what we want to do because that's how you build wealth over the long run, which is taking advantage of appreciation, taking advantage of tax-free depreciation, taking advantage of or refinancing tax-free. So, and you don't get that in a closed-ended fund. In a closed-ended fund, what happens is you take great real estate, you sell it, you pay taxes, you sit on cash, you do it over and over, take more risk. And I've done the math here. We've actually written about this. It's better off to get a 10% compounded on all your money over long periods of time than constantly going through and trying to chase 15% IRRs, even if they are successful, paying taxes and all the downtime on your capital and all that. So that's one of the big reasons why we've switched to this. There is inclusive of that 9 to 11%, there's a 5.8% distribution yield. So if you are an income-oriented investor, there is that. There's a monthly payment, but you can also opt into the drip. So if you want more of a, compound your money, you opt into the drip. About 65% of our investors actually are in the drip itself. That's the distribution reinvestment program. And as I've alluded to already, this is a multi-strategy fund. The fund builds, meaning we engage in ground up development. A very small portion of the fund today is in that, about 16 to 17% of the fund's capital. We can buy core plus and value add, although we haven't done any of that. And I'll talk more about that, why we haven't bought anything in the last 3 years. And we can also lend. So these three strategies, when you think about lending and ground up development or value add and lending, they're actually counter-cyclical in some ways, because when common equity is good, you don't want to be in the debt position. And when common equity or the market is sort of in uncertain times, you want to be more allocated to debt for the stability and the protection. We are only in Sunbelt markets. I actually live in Chicago. We don't invest here for a lot of reasons. I think many of you would agree with me. We've been in the headlines a lot recently, too, for not the kind of things you want to be in the headlines for. So that was really an easy choice and one we made many years ago. It's really the ability and I would say the agility to move up and down the capital structure across different strategies. It's why we can produce positive returns, and why this fund can produce positive returns even in unfavorable environments. So I'm going to start by talking really about multifamily, because protecting and growing capital is about making good choices. And one of the most important choices is the asset class. And certainly if this webinar were about office or maybe even retail, it wouldn't be nearly as compelling as multifamily. And the chart in front of you shows why this is the case. It shows the historical returns on the left-hand side of multifamily, office, retail, and industrial. These are often called the Big Four, and that's from 1990 to 2022. And it also shows the standard deviation of each asset class on the bottom. And what you notice is that multifamily, the blue circle on the left, it sits all by itself. And that's because it is the least volatile asset. It's produced the highest risk-adjusted returns of any of these assets in front of you. And there's some reasons for that. And I think intuitively, most people may know that. We hear a lot of investors who only invest in multifamily. And one is because it's a need-based asset. People need somewhere to live. It's not as correlated to the business cycle. It's also not immune to the business cycle either. It tends to appreciate with inflation. Sometimes, like this last cycle, it was the cause of inflation, but it's certainly, as replacement cost increases, older properties also go up in value, because those older properties, they still have utility and they can be upgraded. And housing generally doesn't become obsolete at all, but Class B properties become Class C. They get upgraded maybe into a C plus, B minus, and you get that whole cycle that continues. The biggest reason, though, I would say for the lower volatility is that multifamily, it has built-in diversification. Typical property has 200-300 units, whereas other property types are more than likely to have concentrated tenancy. Single office or industrial tenant can make up 30%, 40%, even 50% of the rent roll. So if you lose one tenant, your equity can be wiped out, and even the loan might be impaired in those assets. And in real estate, multifamily side, if you have in a bad year, your occupancy might go down to 91, 92%. You're going to be giving away some free rent, but you're still going to be able to maintain positive cash flow, most likely, in those events. And lastly, this is really important to the market that we're looking at today, because with Silicon Valley Bank failing and a lot of these banks tightening credit, multifamily benefits from government-sponsored entities. Fannie and Freddie are big lenders here. In fact, last year, they made around $140 billion in new loans to multifamily real estate. In other asset classes, they just don't have access to these same entities. So multifamily really benefits from that as well. So this next chart, what you see in front of you, it really depicts the housing shortage in this country. And you can see the lack of supply that's been delivered between 2007 and 2023. And by all estimates, this housing shortage, we're short around $3 to $5 million or 3 to 5 million units right now. Certainly, we were making some headway there with all the starts that happened in 2021 and early 2022, but that's sort of ceased now. Over the next 6 to 18 months, we're likely to see a pullback in multifamily prices. You have high interest rates, you have supply coming to market. You just have some fundamentals that don't bode well for existing multifamily. But we view this as an opportunity because the long-term fundamentals are strong. It's really no different than a stock. If a company like Apple drops, it's likely an opportunity to buy more. If I, again, not to pick on office, but if I were talking about office here, that's more of a falling knife. The fundamentals, the long-term fundamentals don't look strong with the work from home movement and how the chess pieces have really changed. Now, in 20 and 21, the market was in the process of addressing this shortage. We hit record housing starts. More than 1 million housing units will be delivered in the next sort of 18 months. And we would typically deliver around 700,000 units. So we're going to see supply outpace demand until late 2024. And 2022 actually had rising rents in the market. So it has helped some of these sponsors who overpaid for projects who bought it 3.5, 3, maybe even 4 caps. But this could be the next shoe to drop in multifamily. And certainly we've been predicting this for the last kind of few months and pounding the table about this. But again, what you have is nothing's really been built in the last 6 to 9 months because of what's happened on the capital market side. So once the existing inventory gets cleared, there's not a whole lot behind it. So all of this is why we have cycles, because you get an oversupply, an undersupply, an oversupply. And this is why this is a big opportunity for the next 6 to 18 months, because multifamily is more than likely to recover after 2024. The next slide here, I would say that the second most important decision we can make is where we invest. And we invest only in Sunbelt markets. So we are in the Southeast. We have an office in Charlotte that covers the Southeast. We also have an office in Nashville that helps to cover that area. We have an office in Dallas that covers the Texas markets. And then we have an office in Denver that covers the Southwest. And our thesis is really we want to be in lifestyle cities, business-friendly cities, low tax states. And this is where jobs are moving to. This is where people are moving to. You just have a lot of workers, too, who have choices out there. So affordability is also a big driver when we get down to the city and the site selection level, because if you can build a beautiful project, but if nobody can afford to live there, then it doesn't really matter. And I'll talk about that more when I go over one of our case studies in Jacksonville. Markets, they're important because the single most important variable in a financial model is really growth. How much can you grow your revenue over your hold period? And real estate investment performance is going to be highly correlated to population and job growth. And we saw this firsthand in COVID when growth was brought forward. We have assets in Austin where our investment more than doubled, and an asset in Chicago where we made an anemic return on our investment. And so when you bring forward high growth, you get high returns. When you bring forward anemic growth, you get anemic returns. And you're better off buying a 4.5 cap or even a 4 cap in a market that grows by 3 to 4% than buying a 7% cap rate in a market with no growth. And I know there are a lot of contrarians out there who want to, look at the cash on cash. You have to measure both sides and really look at the long term. And because we're investing for 10, 15, 20 years, the market selection is really key to this. And it's figuring out where the population is growing the fastest. Now, we don't guess. Where we invest is crucial to our success. And so we've built a tool called Origin Multilytics. It's a predictive rent growth model that analyzes billions of pieces of data monthly. And it's proprietary to us. We hired 2 University of Chicago data scientists with the goal of helping us identify the markets with the greatest long-term rent growth potential. And so, but we don't outsource this. It's a tool that helps augment what we already do, augment what our acquisition officers are doing in the market. And I would say that it's the intersection of human insight coupled with enormous amounts of data that we could never process as human that gives us an advantage in market selection. And this chart is just a graphical representation of that advantage. So the next chart, this is really about, I won't spend a lot of time here, but multifamily enhances a traditional portfolio. So on the left, you see a traditional 60-40 portfolio. On the right, that same portfolio when you add 20% multifamily real estate to it. And the interesting thing is that you not only get lower volatility, but you also get higher returns in the portfolio. And that's because multifamily real estate performance, as measured by the NCREIF, it's actually outperformed the S&P 500 on an absolute basis over the last 30 years. And I find this really interesting as a student of finance, because real estate is a hybrid between stocks and bonds. So efficient market theory would suggest it should generate returns between stocks and bonds, but it actually does better. And so it's a bit of a unicorn in that sense, and why every portfolio should have exposure here. Next slide. This slide is really about our kind of fund dynamics, and I will describe the fund and this chart as one word: agile. And it's the agility that to move in and out of different sector strategy that's enabled us to deliver positive returns in the last 12 months, and why I believe we'll be able to do the same or similar in the next 12 months. And this shows approximately the current portfolio allocation. These are always changing, so they're going to be sort of plus or minus 5%. But 55% of the fund is in credit, in preferred equity. This provides protection and stability to our investments. 25% is in existing assets. These are core plus assets, and these provide cash flow, appreciation, and depreciation. So tax benefits that are really crucial to running the fund efficiently, because I'm taxable, all of our investors taxable. We do have investors who come in here with non-taxable money, but I always encourage them to invest non-taxable money in tax inefficient investments. This is a very tax efficient investment. And then 20% of our fund, but it's a little lower than that right now, it's about 16%, is earmarked towards development. We can't put more than 20% in development. That's a governor on the fund, and that's really our high margin bucket. And that's those developments ultimately, once they're built, then they matriculate into the core plus bucket. And that's our buy, fix, and hold strategy in that ground up development. And then the idea is to reload that capital and always keep that bucket going. As I said, this portfolio allocation, it's not static. We have the ability to tilt this in any direction, and we can go on offense or defense depending on market conditions. And we're constantly evaluating the best places to invest our capital. And you really can only do that if you have multiple strategies under the same umbrella. If we were only a value add fund, that's all we could do with our capital, we would only be looking for value add. We couldn't not do deals. I mean, we could, but then you're just not investing money, and it goes back. If you're going to invest, you have to just make the best decisions you can at that moment in time, whether you want to be on defense or offense. So we can tactically adjust the portfolio, and we have. And if you would have seen this portfolio in sort of the pre-COVID environment, we were about 30% credit and 70% common equity, inclusive of ground up development. And we've tilted that significantly because of the market conditions. And we haven't bought a deal in 3 years on the value add side for the reason that existing deals, they've just been trading too far above replacement costs. Now, we're not market timers. I don't believe that works. But there are sometimes things in the market that you look at and you say, hey, this is not a good idea right now, or this is a better risk-adjusted return than that. And when we're looking at a market that has negative carry, where debt costs are higher than cap rates, it's just not a good risk reward in today's environment to go out and buy common equity, especially when you think revenue is declining over the next year. So 80% of our activities in the last 36 months have been in credit. The other 20% has been in ground up development. And I will say that development was actually the smart investment, because we saw existing properties trading 30 to 40% above replacement cost. And we would rather build at $300,000 than buy at $400,000 per unit. That's what I'm talking about. We had a deal in Denver in Fund 3 that kind of illustrates this point. We built that deal for $270,000. It was a pre-COVID build, so we hit it right. We sold that for $415,000 per unit. But that particular deal, we could recreate all day long at $310,000, $320,000 per unit. So it makes no sense to us to go out and buy something because basis really matters when it comes to investing. And we were happy to actually have sold that in that market. So I'll spend a little bit of time talking about our preferred equity because this is our largest allocation, and this is where we see the greatest opportunity today. Typical preferred equity position for us occupies anywhere between 60 to 80% of the capital structure, plus or minus 5%. And that means the market can deteriorate 20% before our first dollar is at risk. And keep in mind that we're negotiating these positions on today's value, which is actually 10, 15, 20%, you pick it, lower than where we were in 2021. So for that, I just feel like we're actually being overcompensated for risk in today's environment, where 2 years ago, you were, as capital, you were being undercompensated for the risk in the market back in 2021 because everything was being priced to perfection. So deals today are 13 to 14% at occupying a lower position in the capital structure, whereas 2 years ago, we were getting around 12 to go higher in the capital structure. So a very different dynamic today. And so we're getting sort of equity-like returns in a protected position. And that's why more and more of the fund's capital is going here. And we're going to see a lot of opportunities in this space. We hit peak pricing in 2021, and the LTV, the loan to value on those vintages by a Newmark Knight study I just saw, they're up over 90% already. And that means if a sponsor paid, bought a deal in 2021 and they put 65 to 70% leverage on it, their equity has disappeared because the market has come down and it's been wiped out and will probably continue. And so when they go to refinance, they're going to have to come up with tens of millions of dollars to right size the capital structure. And that's where this fund will thrive. Step in with gap equity, right sizing the capital structure. There's going to be just a tremendous number of opportunities. Fund returns. We mark to market on a monthly basis in this fund. So we have a lot of data, and the fund has produced positive returns in 46 out of 47 months. I think you can all guess that the negative month was in April of 2020. That was the COVID month. And in 2022, the fund did very well. It generated a total return of 21%. And last year, I think we're even more proud of the returns. It returned about 9.3%. And fund returns, they really have to be compared to A, other managers, B, benchmarks, because a return in a vacuum doesn't mean much. So this next slide, when you compare our returns in 2022 to what we see as our benchmarks, it really illustrates why you need assets in your portfolio, why we think the fund did very well relative to our benchmark as well. But the advantage of having non-correlated assets in your portfolio. So what you see to the right there is the NCREIF, the ODCF index. That's the Odyssey Core Fund Index. That's actually a levered institutional index. And the index itself, it returned around 7% versus our 9.3%. And other investors, obviously, or other sectors, obviously had a very rough year last year. And one thing I'll tell you, it makes us feel really proud. Like, we got a call from an investor, and I was driving my car. I was actually speaking to my partner at the time, and he just called us up to tell us he had a quarterly meeting with his wealth manager, and the only thing green in his portfolio was his income plus fund investment. It really helped the portfolio significantly avoid negative returns. Certainly, he lost some money, but not as much as he would have had he had that money invested anywhere else. And things like that. We love those calls. We love hearing from investors because it really motivates us. And we want to make sure that we are delivering true value to the individuals who invest with us, and that we deliver on our promises as well. The next slide, I'm going to talk briefly about our investment management, because there is, you want to know what you pay for, the value you get. And this is such a critical piece of what we do. Our investment management team, they're responsible for the execution of our business plans. They are the ones interfacing with the property managers, keeping up to date on our preferred equity positions, seeing developments through from conception through completion. And we are not a vertically integrated firm in the sense that we don't have property management. We don't want to be in property management. We just see that as a conflict of interest for our model. Others do it very well. But we are the group who is training the property managers and holding their feet to the fire. Our team, they've actually created a 70-page playbook that is executed every time we take over property. We use technology in Chicago to monitor the performance of each and every one of our assets. And our team in Chicago, they get daily updates on reviews across our entire portfolio. And it's this attention to detail that has helped us outperform. We were just voted the number 3 best operator by opinion.com. That came in, I think it was last week or the week before. It's quite an honor. Our reviews are 23% higher than the national average for like-kind properties as well. We're not comparing these to Class B and C properties. Typically, we're only in kind of Class A-minus properties. And ultimately, what matters is how this translates to the bottom line. And our bottom line in 2021, we're still compiling the data for 2022. It was 6.6 higher than our competitors. And so when you invest with us, this is what we do as an organization. This is why we have 54 people. This is a division that's responsible for helping to grow and protect the wealth. And this is active management. I'll get into a couple deals right now. I've got about two more slides, and then the contact us page. But this is Niche Hyde Park. It's a preferred equity investment we made in 2021 on a ground-up development in Tampa. Certainly, if you know Tampa, one of the hottest neighborhoods even today. The loan accrues monthly at 12.5%. We went up to 84% in the capital stack. Now, today, the project is close to being completed. But our position, even though we lent up to 84%, it really sits closer to 70% loan to value. Because keep in mind that a development, it has a gross margin of around 35%, which means that if you develop a project for $60 million, that's your cost, you want it to be worth close to $80 million when you are complete. Everybody's in this business to make a profit for themselves and their investors. And so this project has increased in value significantly, which is how our position has actually been de-risked here. And that's how we look at all development opportunities, is not only on an initial loan to cost, which is our governor, but also how it's going to perform on a loan to value. And one of the advantages of us, especially on the credit side, is that we look at everything through the eyes of equity. We only place money in deals we believe are going to work and work well. We're not an asset-based lender. We're not like a bank. We evaluate every single business plan and pass on a lot of deals that are just too thin, even though we are in a protected position, because candidly, life is just easier when the sponsor makes money, and we don't want to be in a position where the sponsor is doing a deal that's thin and maybe they're motivated by getting the development fees done. Because when common equity is underwater, people can behave very differently, and we do our best to avoid those situations. So the next deal is called Linden House. I believe this is my last slide, Jim. This is a ground-up development deal. This is located in Jacksonville, Florida. And Jacksonville is actually the 3rd fastest growing city in the country. Most places, when you're pulling up anything online, reading about home prices, reading about affordability, lifestyle, Jacksonville falls into those categories. And for us, the reason why this jumps off the page, it really has to do with affordability and lifestyles. And these are the two variables that attract the work from home employees and the retiree. And you're in a state that has no taxes, and then you're in an environment where rents are still affordable. My son actually lives in Palm Beach, Florida right now, and we rented him an apartment. He's taking a gap year. And for his studio apartment, we are paying $2,400 per month. Palm Beach is not affordable at all. But here at Linden House, our 3 bedrooms are renting, or on a pro forma basis, are $2,400. So you can see the gap and the disparity, and why, if you work from home, you would much rather go to Jacksonville, live in a no tax state, in a great environment, but have, you could rent a 3-bedroom or you can rent a 1-bedroom for a fraction of the cost of what you can rent one in Palm Beach for. And in 2020, there were really 2 markets that jumped off the page when we ran our rent growth prediction model. They were Colorado Springs and Jacksonville. And our Origin Multilytics, it predicted rent increases in Jacksonville higher than any other city we operated. And we now have a total of 5 deals in this market. Most were started in 2021 from a ground up construction process. And not all of them are in this fund, but certainly we have exposure in this fund to Jacksonville, which we're excited about. So this deal, it's doing exceptionally well. Market rents are around $200 per month above what we underwrote. We never see that. Typically, if you're right, you're getting $50 to $75, but this market is really taking off, and these are strange times. We've never seen rents climb as fast as they have been. But the offsetting factor is cap rates are higher everywhere here. Great equalizer is growth. So we're going to do very well on this and likely surpass pro forma projections. So anyone who invests in the Income Plus Fund will have exposure to this deal and many more. And this brings me to my last slide. Jim, I hope we're somewhere on time. I want to thank you very much. If you want to get a hold of us, you can. You can go to our website, origininvestments.com. You can scan the QR code in front of you, or you can email us at investorrelations@origininvestments.com. So we appreciate the partnership with WCI, White Coat Investor, and look forward to speaking with all of you soon.
Awesome. And if anybody's having trouble remembering all that contact information, all you got to remember is Origin. whitecoatinvestor.com/origin will get you where you want to go to get more information. Well, we just have a few minutes to do questions, but before we get into that, I wanted to talk just very briefly about my own investment in this fund. I started in February 2020 with a $100,000 investment. I think that was the minimum at that time. And so and I'm in the DRIP program like most of the investors. So I just reinvest all of my dividends. And I think I've got something like $134,000 in there now. But I just got my K1 for this fund well before the April 15th deadline, I might add. And it showed that I got about a little over $7,000 in distributions last year. And of that, only less than a quarter of it was actually taxable income. It was $113 in interest, $154 in ordinary dividends, $65 in qualified dividends, and a little over $1,100 as a short-term capital gain. So that's pretty darn tax efficient for a fund that's focused so much on income, that has so much preferred equity in it. Is there anything you expect to change with the fund that might make it significantly less tax efficient than it has been?
Yeah, Jim, a good question. And, as we think about tax efficiency, certainly that's a secondary goal. You never want to let the tail wag the dog. So as we started tilting the portfolio more and more into preferred equity, it's going to reduce the tax efficiency. So if we go back to even 2021, I believe we returned 94% of the distributions came back tax-free. So this is a little less. So the more the portfolio is tilted towards preferred equity, it's not going to be tax inefficient, but it's going to be less tax efficient. So I think what you just described is probably the least tax efficient. And the way that we structure our preferred equity deals is a little bit unique because it's a common equity position that has preferred equity rights. So common equity is subordinated to us, but we actually don't have maturity. And that's one of the things that gives us an advantage in the market with some of these sponsors. And candidly, there are put rights and things like that, and there's triggers that we have if they don't meet certain goals. But we have a deal in this fund, you probably know it, Lively, where the sponsor has built the deals. They pay a 13% interest rate. That's accrual. They performed incredible on their development, and now our positions are sitting there at 58 to 60% on a loan to value basis, and we're accruing 13%. So, like those things. But when those mature and they pay those off, we will actually get long-term capital gains because of the way those are structured. So if we were true preferred equity or true mezzanine debt, that would be taxed very differently. So we try to find creative structures that work well from the tax efficiency, and it's something we think about constantly.
Now, this is an evergreen fund. I mean, you can invest in it at any time. Tell us a little bit about the liquidity getting out.
So the liquidity getting out, first of all, we have gated our fund somewhat, right? And you're familiar with this, I'm sure, that we want our investors to think about this long term. We have 5 years, right, of penalties, and there's a lockout for the first year, then 10% the first year, and then it scales down. It might be 7.5, 5 to something of that nature. And it was interesting because as we saw with Blackstone, this sort of, they were very friendly about their liquidity and their mechanisms and the ability to get out. And we saw a run for the gates. And we want our investors to think about being invested for 4 or 5 years. So if an investor wants to get out, they can. They just send us a notice. We have tender offers, I believe, every quarter that, but we also have the ability to limit, right? What we don't want is a run on the banks because, Jim, if you want to stay in your investment or I want to, but suddenly we have 40% of the people who want to get out, then we're selling assets at fire sale prices. And that impacts you and me. And when we think about risk management as an organization, this is one of the things we took out of the page of Citadel here in Chicago, who happens to be a big hedge fund. Well, in 2008, what happened was there was a run for, kind of the bank run on the banks, right, in hedge fund world. And those who had to redeem and didn't have these lockup mechanisms, they actually went out of business and their investors were adversely impacted. Citadel shut the gates and they got through to the other side. And then they opened the gates and said, okay, if you want to get out. And people are like, no, I'm good now, right? After they made 40 or 50%. So we sort of think about it like that. But we want to put that liquidity in the hands of the investor. And that's why we've gotten out of the buy, fix, and sell and into the buy, fix, and hold. And you can determine when you want to exit the investment, because certainly you have a basis between where the unit price is trading and where you invested as an individual. And you'll pay taxes once you sell that those units.
Awesome. Well, Michael, thank you so much for coming on and doing this webinar for us. The Income Plus Fund, I think, is a great fund that you guys have been offering. And obviously, I like it or I wouldn't be invested in it. But I appreciate what you guys have been doing, managing my own money, as well as helping white coat investors to reach their financial goals. For those who want more information about Origin, again, that's whitecoatinvestor.com/origin. Thanks so much.
Thank you, Jim.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.